we remain quite constructive about equity markets. The key thing here is that the risk of an economic hard landing has been significantly reduced. One way you can observe that is just simply looking on Google Trends, and it shows that internet users are less preoccupied with a global recession than they were a year ago. There are a number of reasons for that. One is that Europe has avoided an energy crunch. Two, China has got rid of its zero COVID policy and is reopening. And I think the most remarkable part is the fact that consumers in the US and the UK, in Europe, are showing increasing resilience. And that's simply because we're still at more or less full employment. So there's still the income there to keep spending going. So given that that risk of an economic hard landing has been reduced, I would say that's one of the key bases for markets to recover, which they have done since last October.
It's lovely to see a fellow optimist as Karen on the show, but I'm concerned. You know, we've got a terrific story on CNBC at the moment, which is pointing out there is a global commodities rout going on, and I'll just paraphrase some of it. The S&P GSCI commodities performance year-on-year down 22%, energy down 23%, industrial metals down 4% as well. It doesn't seem to me that the commodities are indicating that demand is picking up anytime soon, which would suggest that there's an economic issue, which means that the markets, perhaps, Daniel, are a little bit complacent.
Well, if you look at expenditure on goods, consumer goods, they have come down. There's an increase in supply of oil. So this probably explains some of the arguments why the commodity prices are coming down. But the optimism is looking at consumer services. And certainly if you look at the manufacturing surveys and the PMIs looking at services, the services component, these have been splitting up from the manufacturing sector. And these have been going very, very strongly indeed, particularly in the UK. I noticed that the UK composite PMI is actually the strongest within Europe. So it does tell us that people are actually going out and spending, particularly in services, and that's supporting the overall global economy. Remember, it's the service sector within developed markets that is the lion's share of overall GDP. So that's where the optimism comes from.
Daniel, can I ask you about the market and how sensitive it is to interest rate hikes from here? Because we had the minutes yesterday, market was a little bit weaker on the back of it, still watching and waiting to see the data. But the messaging is we've got a couple more rate hikes to weather from here. Do you think the market is concerned about those rate hikes actually coming through, given many actually wanted to pivot and a cut later this year? Or do you think that the market is largely comfortable now that we're still going up and that we're just going to hold out for a little bit longer till the end of the year until we get further direction on the data?
I think it's really the latter part, really. The key point here is also that the Fed is towards the end of its rate hiking cycle. We saw within the minutes that most of the participants, they were all in the consensus of more rate hikes increases later this year. That's not new news. We already saw that in the FOMC with their interest rate forecast. We may expect a 25 basis point increase in the July meeting and maybe one more rate increase towards the end of the year. But that should be about it. And that's probably why the equity market is a little bit more optimistic than, say, the bond market, because they can see light at the end of the tunnel with these hawkish signals coming from the Fed.